Could you explain the difference between an initial public offering, an IPO, and what is the biggest difference between the secondary market?
The secondary market is where it's available to the public, and you can see the valuation on an index. And there right before this. This is investment banking, and it's trying to raise money for these companies and to sell these shares. And there's all sorts of evaluation as to what the price is, the value of the company is worth. It's the market that tells you to some extent what the value is. So you're trying to predict how the market responds. To take a company public, there are several ways to do it. We used to have this, we still do this SPAC model, special purpose acquisition company. But this is all on the investment banking side, and it's generally not for retail and investors. Once it gets on the secondary market, then it's open to retail investors. And there's this perception, and there's some truth to it, that you see this with university endowments, the hedge funds, that they have access to some of these investments that the retail investor doesn't have. And that, they can outperform sometimes because of it, but of course they're taking risk as well. So
Mhm.
it's in some ways, I think it's a great system to be able to create a company and take it public. And that's, a sign of, I think, a capitalist economy, so to speak, that people can create a company and invest in it and raise money, take it public. But of course, there's enormous amounts of regulation involved. And we have companies where we see, of course, they trade for pennies, and anything under $5 a share, we consider what's called a penny stock. And these can be super volatile. There can be manipulation. So I mean, it's an interesting thing. Of course, our concern is for the retail investor, our clients, that they don't have surprises. And that's where we work in the secondary market, where it's open to the public, and we get a better feel for the value of something. Of course, we also have all sorts of services we subscribe to, Morningstar, Vector Vest. Um, there's just a lot of analysis out there. And of course, the money managers that we work with have their own analysis. And so we can combine all of this to get a feel. I mentioned to one of our newer clients that people will come to us with a request about a company, about buying a stock. And we look at this, and there's like no earnings. It is absolutely something that we would not recommend, particularly often these are more conservative investors. And it's just something that they heard about us. It could be word of mouth. It could be watching a business news program. And so we get into it and look at it and say, oh, it's $90 a share, and the analysts think it's worth $4 a share. And you do get those, not uncommon, those discrepancies. So I mean, and again, you have to take that with a grain of salt, because it could be that it's still too new to fairly evaluate, and that there's a lot of growth potential still.